A very common planning issue we see with affluent households is the accumulation of large retirement accounts. Over the course of a long career, it's not unusual for someone to build a traditional IRA or 401k worth $2, $3, sometimes even $5 million. And while that sounds like a good problem to have, large pre-tax retirement accounts can create some very real tax planning challenges later in life. Welcome to the Wealth and Transition Report, everyone. I'm Mike DePaul, a private wealth advisor with Newport Wealth Advisors here in Southern California. Large retirement accounts are often the result of years of disciplined savings and investing, and they can be a tremendous asset for a family. But in practice, what we often see is that the tax liability embedded inside those accounts becomes an increasingly important part of the financial planning conversation. Because with traditional retirement accounts, 401ks, 403bs, IRAs, every dollar has effectively been deferred, not avoided, from taxation. Eventually, those taxes have to be paid. Sometimes you even hear advisors referring to these accounts as tax time bombs. This is where planning challenges begin to emerge. Once someone reaches their early 70s and required minimum distributions begin, those distributions can become very large. For example, a married 75-year-old with a $3 million IRA would be required to distribute roughly $120,000 that year. And those distributions are taxed as ordinary income. And those required distributions increase every year as the IRS life expectancy factors decline. In practice, what we often see is that those distributions, when combined with Social Security, investment income, and other sources of income, push households into higher tax brackets. And the impact doesn't stop with taxes. Large retirement distributions can increase Medicare premiums, which are tied to income levels. They can also reduce flexibility around how other assets are managed or distributed. But perhaps the most important impact shows up when wealth begins transitioning to the next generation. Under current rules, most non-spouse beneficiaries who inherit a traditional IRA must distribute those assets within a 10-year window, which means the tax liability doesn't disappear, it simply shifts to the next generation, usually your children. There's another dynamic that often makes this even more challenging. Generally, when people pass away, their kids are reaching their peak earning years. So if these kids are already in high income tax brackets, the additional income coming from the inherited distributions can push them even higher. The reaction we get a lot from the next generation is something like, hey, thanks for the inheritance, mom and dad, but wow, that's a huge amount of taxable income. So this is where thoughtful planning becomes very important. Strategies like Roth conversions, distribution sequencing, long-term tax coordination, they can materially influence how that tax liability unfolds over time. But these decisions rarely exist in isolation. They interact with estate planning decisions, investment strategy, and in the state of California, where taxes are very high, state tax considerations have to be considered as well. Which is why situations like these often require coordination between multiple professionals, financial advisors, CPAs, and estate planning attorneys, to ensure that the strategy is working cohesively. Look, large retirement accounts can be a tremendous asset, but they also introduce planning considerations that many families don't fully recognize until later in life or until it's too late. And in complex situations like these, the objective isn't to create more complexity. In fact, it's the opposite, to simplify through clarity and alignment. Hey, if you enjoy these quick reports on complex planning issues facing affluent households, please follow the Wealth and Transition Report on my YouTube or LinkedIn channel for future videos and insights. I'm Mike DePaul. This has been the Wealth and Transition Report. Thank you for watching.